All right, let's dive into something that can honestly change the way you think about investing. We're talking about a powerful strategy that helps you handle the crazy ups and downs of the market. It's called dollar cost averaging. And trust me, by the end of this, you'll see how it brings a whole lot of discipline and, frankly, calm to what can feel like a really chaotic game. So, let's get into it.
I mean, come on, who hasn't been here? You're staring at a chart, completely frozen, just haunted by this one question. If I jump in now, is the market going to tank tomorrow? But if I wait, what if I miss out on a huge run up? This fear of getting the timing totally wrong is probably one of the biggest roadblocks for any investor, big or small.
And that pressure? It gets cranked up to 11 when you're thinking about putting a big chunk of money in all at once. That's what we call lump sum investing. It's basically a high stakes bet on one single moment in time. If you get it right, hey, that's amazing. But if you get it wrong, you could be starting out in a serious deficit. It's a strategy that's so often driven by emotion, by trying to be a fortune teller. But there is a much simpler way. And that right there brings us to our main event. Instead of trying to find that one single perfect needle in a haystack moment to invest, this strategy is all about consistency over trying to see the future. It's called dollar cost averaging, or DCA for short. So what is it exactly? Well, at its core, it's actually really simple. Instead of making one giant investment, you just commit to investing a smaller, fixed amount of money on a regular schedule. Maybe every month or every other week. And here is the absolute key. You do it no matter what the price is doing. Whether the market is up, down, or just going sideways, you stick to the plan. Period. The difference between this and throwing in a lump sum is, well, it's like night and day. With a lump sum, you're making one huge bet with a ton of timing risk. It's so easy to let fear or greed take the wheel. DCA just flips that whole script. You're making regular, smaller investments, which automatically dials down that timing risk and replaces all that emotional guesswork with a disciplined and often totally automated system.
Okay, so that's the theory. But how does this actually play out to your advantage? Well, the whole goal here is to smooth out your average purchase price over the long haul. Let's break down exactly how it does that.
It's really just a simple four-step process. First, you decide on your fixed amount and your schedule. Let's say €100 on the first of every month. Step 2, and this is the hard part, you commit. You invest on that schedule, ignoring all the crazy market news. And now, this is where the magic happens. Because your investment amount is always the same, you automatically end up buying more shares when the price is low, and you buy fewer shares when the price is high. It happens without you even thinking about it. I know that might sound a little bit abstract, so to make this crystal clear, let's just run the numbers on a quick hypothetical scenario. You'll see it click right into place. Okay, check this out. Imagine you're investing a steady €100 every month. In January, the price is €10, so your $100 gets you exactly 10 units. Simple enough. But then in February, the price drops to €8. But wait. That same €100 now buys you 12.5 units. More for your money. Then in March, the price bounces back up to €12. Now your €100 only gets you about 8.3 units. Do you see that pattern? You automatically bought the most units when the price was at its lowest point. So what's the grand result of all this? Because you naturally bought more units when they were cheap, the average cost you paid for all your units actually ends up being lower than the average market price during that whole time. You've essentially lowered your risk without ever having to predict a single thing. It's pretty cool, right? So we've seen how it works, but let's talk about the real-world benefits. Why should this strategy actually matter to you in your own financial journey? What's in it for you? The advantages here are just huge, and they go way beyond the numbers. I think the biggest one is psychological. It takes your emotions out of the driver's seat. By just automating the plan, you're not tempted to panic sell at the bottom or get greedy and buy at the very top. It builds incredible discipline. And, just as important, it makes investing accessible to literally everyone. You can build real wealth over time without needing a giant pile of cash to get started. But here is where this strategy truly reveals its superpower.
It's not just for normal, everyday markets. No, it absolutely shines when things get really, really scary out there. This is the key mindset shift. With DCA, a market downturn stops looking like a disaster. It starts to look like a sale. I mean, think of it like a Black Friday sale for the exact assets you wanted to buy anyway. They're just on a massive discount.
Seriously, think about it. During a crisis, while everyone else is panicking, your fixed monthly investment is just quietly scooping up more and more units at these bargain bin prices. You are systematically buying low when everyone else is selling low. And that means when the market does eventually recover, and history tells us it always has, you are perfectly positioned to ride that recovery all the way up. It's a mechanical way to turn widespread fear into your own personal opportunity.
So, as we wrap things up here, what's the big central idea you should take away from all of this? It really all comes down to a fundamental shift in your entire mindset about investing. And this is it, right here. Dollar cost averaging teaches us that successful investing isn't about the impossible game of trying to predict the market's next move. It's about consistency, it's about discipline, and it's about giving your money the one thing it really needs to grow: time. So I'll leave you with this final thought to chew on. Once you have a steady, automated, disciplined plan in place, all those scary headlines, all that daily market chatter, it all just starts to fade into background noise. How could embracing a strategy like this change not just your portfolio's health, but your own peace of mind? Thanks for tuning in.